if you're scratching your head seeking for a right answer to this question, you and your wallet might be in an economic corner. But how to get out of this corner, you may ask? I don't have an obvious answer to you, but get something to you that might cheer you up. So it's scientifically proved that watching and implementing the knowledge of Blockrevision channel is salutary for your financial condition being. So, not getting this anytime further, let's get to another episode of Blockrevision, and it's 8:45 New York's time. That's why it's definitely the best time to get it through. So, we are heading into economy view, and right here, right now, we have at first the news that recently spooked the market kind of needs a resemblance as Gazprom shuts down Nord Stream. That's the something that may have a long-term reverberations on what the energy market will look in Europe. So Gazprom is the one company that recently shut down their pipeline, and that has been indefinitely. That's why we cannot expect the Gazprom to retrieve their power direction to Europe any time soon, at least by the time of the war between Russia and Ukraine eventually end up. So that's the outcome that it's not right now on the horizon. There is not an obvious light in the tunnel. That's why we cannot expect this one to eventually get over. This winter in Europe is going to be kind of a chaotic. Russia is weaponizing energy supplies as part of an economic war with the West, and that's one of the aftermath of this Russia's invasion of Ukraine. So the problems are still to be persisting. So are we ahead of another high inflation decade? Just have a look at US Treasury yields versus long-term inflation rate, and that one is showing us that we might be ahead of a possible reversal, the long-term reversal of this 10-year Treasury yield. So the Treasury yield, if that will be an indicator, if this 10-year Treasury yields will be an indicator. This 10-year inflation rate model will be an indicator. This 10-year Treasury yield would need to rise to around 4.5%, line up with the current expected pace of this long-term trend of this curve. So inflation is right now eating deposits of interest-bearing bank account, and that's something that also prompt more and more investors to possibly not sitting on their cash. That's why investing will be something of a possibly very important on the stock market indexes. So maybe even if there are many of market participants awaiting for another dip, there are also some of them that are claiming that we are already over and the bull market rally may start right away. So we might be not yet at levels consistent with a market trough. So is there another pain to come ahead? There are few factors. The first one is this residential real estate conditions that weakened recently, and this home sales fell in all 12 districts. That's why residential construction remained constrained by input shortages. Beige Book recently also found that housing market has problems. However, the next several quarters in terms of stock market might be also end up not very bad for many of equities, as most significant downward revisions to forward earnings per shares might be yet to come. So these are two factors that may bring those valuations lower. Also, with these mortgage rates that also are becoming a burden for the new buyers, those mortgage rates are skyrocketing to 6.25% of now, and that's the average 30-year fixed mortgage rate. So right before that summer bear market rally set in, right now we are having these mortgage rates eventually that very high mortgage rates that bringing that rally to unwound. So mortgage payments of those rates to buy the dream house, the customer's dream house at these ridiculous prices are something that pushing many of investors off. Labor market still strong? Yes, but to some extent. Labor market is stronger than average if the recession began next month, but it wouldn't be without precedent. So we had the scenario where during the 70s, the month before the recession, the economy had an average pace of job gains over 250k, and that's highlighted right at this bullet point. So companies reduce people's hours. If we just have a look at the chart, companies reduce people's hours before going through the process of layoffs, because the slowdown could be temporary and they don't want to fire and then hire again. That will be full of a friction action, and that is why even if this US jobs market, US jobs report will be a potential one to scale toward a third jumbo-sized Federal Reserve hiking interest rates this month, that may be such last hike, as those markets are beginning to deteriorate and those divergences are becoming more and more significant. Pain obvious. And so recently we had projections during first quarter, even the second quarter of 2022, that those yield curves were right more flatlined than here, the recent one. So we were expecting this inflation to eventually not accelerate to that extent that we are right now seeing that we have 30-year yield curve level at those levels, as we are seeing the economy within 6 months. And that's why we are expecting this inflationary pressure to hang on for more years to come, and the pain to become more persistent. That's the investor's view, and that's the kind of a smart money also viewpoint. China on the pathway of a slowdown. So we are right now expecting those many gauges of China to eventually slow down, as in particular these troubles of what's happening in Europe, this double-digit exports growth in the past is hot. That been hot as right now and not sustainable. Mr. Zhang said to achieve faster economic growth in the next 12 months, China's domestic demand will need to play a bigger role. But for this one to happen, we would need to get relaxed this COVID-0 policy. Otherwise, those demand cannot be sustained and they can't keep up those projections. So we can find that global demand for smartphones, semiconductors, and so on, the technological components, is decreasing as of the troubles persisting. UK will reaching up to 20% inflation rate. That was the projection made by one of the bank that UK's inflation rate may get up over 15% up to 20% in 2023. So UK's cost of living crisis only just began, analysts claim. So this Liz Truss that will become the Britain's third woman to hold the Prime Minister's post eventually will bring over to the market this yet to be announced government support measures, but many of the analysts are acting in tandem that might be mindful, but it will be rather delaying problems of British economy rather than removing recessionary risk. So we are right ahead of a major problems, even with Liz Truss foretelling that she will build more nuclear power. She will roll over some plan regarding this that might be not the one that will be satisfactory in terms of meeting the terms of these blackouts, for now at least. Market outlook and Jackson Hole reverberations showing us we need lower inflation, lower interest rates that could ease the selling pressure on the markets. Right now we are struggling with that viewpoint where stronger than expected number would hit risk assets. So there is like a more like a sell on the good data event. So the only one thing that would ease that pressure and revert those tendencies will be lower inflation to appear much lower than right now, with the slowing tendency yet to happen. So right after Jackson Hole, we do not expect the Fed, even if turn up and make a speech this week to make a pivot right now before inflation rate eventually get down. So we are hiking interest rates until the market won't break to that extent it will bring a heavy pain. Otherwise, we are still on the way of another hike rates, and maybe the 2022 will be the entire year of such strong interest rate hike as 75 basis points. But I do find that possibly also looking at this seasonality, the fourth quarter will be the one more optimistic one. So just have a look at this one. S&P 500 performance during midterm election years since World War II, and that bringing one of the summarization that we are the right somewhere in the somewhere the most difficult moments for the market in terms of seasonality. So this fourth quarter is supposed to be much more optimistic, but before that we still are ahead of the entire September to May. So just having a look once again at this note, the low for the year at the end of September, followed by a strong Q4 rally. So that's also the one that may become. In terms of crypto outlook, pro-inflationary era, if that happen, if this era will be exactly this at the high inflation rate as it was back in the 70s, hopefully not, that will bring possibly more interest, more investors' interest in those assets that are not prone to such inflation. Among them, the gold, among them, precious metals, and obviously digital gold, that is Bitcoin. Right recently, we've noticed that BTC long-term holder supply, even if it's increased recently, we can observe that this supposed to revert anytime soon, but yet is nowhere near from the over. That's why we may expect another low for Bitcoin before this reversal eventually start. We have this seasonality of when November's time will be the one of the pivotal moment, and there will be the beginning, the summer of the beginning of this Santa rally that is appeared to happen possibly Q4. That's why it's very very interesting to track. In terms of market movers, let's jump into a economic calendar, and on Wednesday we I need to switch as it's next week, sorry. On Wednesday we had already the balance of trade in the US, and that one shown the lowering tendency, so its deglobalization element is it's a negative territory. That's why we can find that after this pandemic crisis we are eventually getting this through and reverting the tendency. That's why that might be possibly better for the US economy. Right after we had from Australia balance of trade. Let's have a look at this one. This one showing, however, the downturn as this demand for commodities is decreasing right now. So recently we observed a sharp boost in sales of metal ores and minerals as coal, coke, and briquettes. Right now this demand is getting to be diminished. In terms of next elements, ECB interest rate decision is eventually at 0.75 basis points. That's why it's following the guidance, but it's not bringing the better outcome for the euro-dollar tendency, as the dollar's Fed is about to hike interest rates by the similar amount. That's why this parity is still to be threatened. Parity to maintain is about to be threatened. In terms of China inflation rate year over year, this one is expected to remain at 2.9%, but is boosting a little bit, but still at the satisfactory level for the government, as not have to face that problems of high interest rates due to their commodity commodity demand and this diminished this diminished consumer quantity of recent. So on Friday we have wholesale inventories also to watch from US, and that's it in today's in this week. Let's have a look right now at trade idea section, and this one. In this one I have for you as yesterday US 100, as it's in a very interesting spot. We have rebounded from the area I've pointed yesterday, and I do expect that US 100 will eventually sell off here right to around this areas of 12,120s, and right after will have its march to 12,500s in order to retest this trend line. Also, this trend line coincides with this recent highs. That's what I think will be as a confluence if we just hit two resistances in a row. So in terms of positioning, that's also very interesting to watch is this number of clients that bought US 100, and this showing us that more of them has bought, but position value is more to the downside. That's why I do expect this divergence to happen, and this little rebound is entirely deserved. So what I do expect with a tight stop loss to have a long position from an area of 1260-ish with a stop loss right around 1245 around, with a potential profit at 12,500 will be something to consider in order to make a such a bet. So this relief rally is highly expected for me, and this risk reward ratio at 3.69 is also a decent one in order to consider of a trade. So with this rebound, I do expect this rally to happen eventually, but remember about tight stop loss. If this scenario won't fulfill, remember that you would better not risk much of a capital. Just risk about 2% of your trading capital at trade, as it's a marathon sprint. That's why you should better have a smaller amount of capital. So that's it in today's episode. Thank you very much for watching. If you have any questions, just put it in the comment section below the video, or or you can find me also on Twitter. That's Blockrevision account. So you may find it right in the description below the video. So we are seeing each other tomorrow at 8:45 at the very interesting, hopefully very interesting, another episode. Thank you, and see